Welcome. In this module, we'll talk about some of the key financial information that can be useful in starting to understand what's happening internally within our organization. Remember, we talked about the external world and how that's dealing with how that's going. Now we want to look internally and talk about what capabilities and sorts of resources we have. And one of the ways to measure that or understand that is through the financials and how the financial situation looks for our company. This particular lecture is just going to go through what those various ratios are and talk about them a little bit and why they're important. Remember, financial information is only useful in a strategy context when it tells you something about the organization that allows you to understand how effectively it's competing in the marketplace. So we'll talk about them in that context. We have a separate module which talks about how we do financial analysis whenever we think about strategy. But in this particular case, I'm just going to give you the basic ideas of what ratios to look at and why they're important. And we'll just go through them there's a lot of them, and we'll just go through them and talk about them a little bit. All of this information is available also in the textbook. But let's talk about the first area to look at, which of course is profitability ratios. That is, how much money do we get to keep? Do we get to give to our investors? Do we get to invest in future operations once we've operated, once we've run the business for a period of time? That's why that's important. It tells you, we've been running for 6 months or we've been running for a year or whatever. How much money have we been making? Is it worth it? Can we sustain ourselves? That's what profitability ratios look at. And the first and most important, well, not the most important, but the first, they're all important, I should say, is gross margin. That is really the one that tells you whether or not you even have a chance to succeed. Gross margin tells you if you take your sales and you take out all the costs of goods, after you just pay to put whatever it is you're selling on the market, on the shelf, after you just pay for that, do you make money? Because if you don't, if you're selling something that costs you $100 and you're only selling it for $95, there's no chance whatsoever unless you can change either the price or the cost. So gross profit margin tells you whether or not you have any chance of bringing enough money in to sustain your internal operations. Operating profit takes it to the next level and says, well, once I pay all my people, once I pay my rent, my accountants, and all of that, do I still have money? Now, if you have a positive gross margin and a negative operating profit margin, there's possibility to cut costs and still make money. And that's one of the reasons why we look at these two different things, these two different ratios differently. You can also look at them in relation, profit margin in relation to sales, in relation to assets, in relation to equity. There's all different ways to be thinking about how your profit works. And that tells you essentially whether or not your company has a chance to succeed and how well it's succeeding and whether it will have the financial resources going forward to do what it needs to do, and also where to look. Because you'll note you can look at these at the company level, you can look at these at the business unit level, you can look at these at the product level, you can look at these at the product family level, you can look at them at the individual product level and look at your product mix. There's all sorts of ways to drill down and start to understand where your issues are and where your problems are. So that's the profitability ratios. Secondly, in terms of how well you're running your operations, are your customers paying? Do you have enough capital to operate? You have liquidity ratios, and that simply tells you, it's a balance sheet type of measure that tells you how much money you have to pay your bills on a regular basis. Do you have enough cash or capital to do that? You know, what is it do you have? Can you pay for your interest on your loans and that sort of thing? How much capital you have to work on. Liquidity means how much cash you have. So from like an individual checkbook perspective, do you have enough money when you go out to the store that you can buy, you go out to dinner with your friends, you can pay for the bill and all that. You don't have to use a credit card because you don't have any money in the bank. That's the idea here, the liquidity ratios. The other key one here that links to the balance sheet is leverage ratios. And those measures tell you whether or not you're taking advantage of other people's money. People say you don't borrow money, neither a borrower or a lender be. Well, actually, Shakespeare was being a bit ironic in that, because really the way that you really grow quickly is by using other people's money to invest in things that bring you future returns that allow you to pay for the other people's money, but in addition make more money than you would have otherwise. And of course that makes it trickier, and that's why you want to make sure you manage your leverage at to the right level, and how much, given the amount of risk in the marketplace, how much leverage you have. The more risk in the market, the less leverage you want, the more you want to pay from your own capital. But if there's very little risk, if you continually have the same customers every year, you can leverage because you're pretty sure of your cash flow. You can borrow some money and you could open up a new office as long as you have very little risk in your operations. And that way you can expand, and you can expand now rather than having to save money and then do it in the future. But you have to do that very carefully. And you can see that you have, long-term debt to equity ratios and those kinds of things, which are the leverage ratios. This requires a kind of deep understanding of financial and financial risk, which we'll talk about in later modules. But this is just to give you a sense of why we care about these particular items. We also have ratios that are support of how well you're managing your operation. These are called activity ratios. For example, how much inventory do you have on hand? Typically you say, oh yeah, I need a lot of inventory, so I'm going to have a lot of stuff on my shelves and warehouses. But it costs you money because you have to buy the things and put them on the shelves, so you don't have the cash. Or you might actually have to borrow a little bit to put some inventory on the shelves if you have a busy season, in which case you're paying for that, having that inventory, and you're even paying with opportunity costs if you're putting money there instead of investing it in other possibilities. So you want to actually have as little inventory as you can, but have no outages. You want to have all the products that people want when they come in the door, but you don't want to have 2 of them on the shelf if they only want one thing. Right? So managing inventory, that's what that measures. The same is true of how fast you turn over inventory, whether or not it's in days or weeks or months or years. Sometimes people have inventory for a long period of time, and that's bad because that means that the inventory probably spoils, goes bad, or is no longer has much usefulness, as well as having too much material. That tells you how much inventory, how much your current shelves have, if you will, shelves, whatever it is, that needs to pay for for the amount of activity you have, number of customers purchasing it. If you're in a store and you're trying to buy cereal, do you have enough cereal on your shelves to last you 6 months? Well, if you do, that's too much. A week, maybe a couple of days. So that's what that one means. And then you also have collection period, which means whenever your customers are borrowing money, you're sending them an invoice. Are they paying it in 30 days, or are they not paying you? Right? That's your collection storyline. And then, of course, there are other measures that typically relate to how well your equity investors or shareholders feel like they're participating in the growth and the value that you're creating. So there's dividend measures, price to earnings, which is the value of the market is paying for the shares versus how much each share earns at a given time frame. How much dividend you pay, that is, if you pay 7% or 3% or whatever of the value of the share, then that's a measure that investors can say, I'm willing to take the risk of investing in your company because you are paying this dividend. That's how investors get some of their money back. Rather, if they don't sell your share, the way they get some of their return is through inventories. And then probably the most important single measure in a small business and even in a large business is free cash flow. That's how much money, after you've paid your investors, after you've been paid the government its taxes, after you've paid out dividends, how much cash do you actually have in your business that is generated from operating your business that you can then invest in the future? You can invest in new products, new equipment, R&D, all of those things. Now remember, as I mentioned, all of these ratios, and it seems like a lot, but really once you get used to them, you kind of know which ones to look for. You could apply them at the business unit level, at the product line level, all of the cars of a particular type, at an individual factory level, how much the factory is producing, or at an individual retail store level to find out how well that retail store, one retail store, if you're at Walmart, you can look at one retail store and figure out how well they're managing their inventory at that store. using this kind of analysis. That's why it's so powerful and so important. So we'll continue the discussion in this module next time by talking about key resources and capabilities. And always keep in mind that in strategy, the financials are an important indicator of where you look for issues, where you look for opportunities. But what you really have to understand is what resources you have and what capabilities you have in order to find the key success factors in the organization, in the marketplace, and point those capabilities, build those capabilities, get those resources, and start to mine the value that's in the external market that you've identified in your analysis. So that's where we'll go next in Lecture 3.